Welcome back. Let's start with a reality check most people would rather avoid. Silver isn't racing toward $300 because the economy is thriving. It's climbing because the system underneath it is breaking down. This surge isn't about investors suddenly falling in love with shiny metals. It's about the dollar losing credibility. As purchasing power erodes, silver has no choice but to rise, acting as a mirror that reflects the true weakness of the currency. Here's what many still miss. Silver isn't magically becoming more valuable. It's simply doing the job of honest money, exposing dishonest money. When governments run trillion-dollar deficits, when central banks monetize debt, and when interest rates are kept below inflation year after year, the currency must decline. That's not opinion, it's math. Silver is the measuring stick. The Federal Reserve wants you distracted by prices, asking why silver is up, why groceries cost more, why rents are exploding. What they don't want you asking is the deeper question: what happened to the dollar? Because once you confront that, the illusion falls apart. For decades, Americans were told inflation was tame. Statistics were massaged, substitutions introduced, and asset inflation ignored. Stocks, bonds, and real estate soared, not because productivity exploded, but because money was cheap and abundant. Silver's warning signal was muted through paper contracts and financial engineering. But reality can't be suppressed forever. Eventually, physical demand outweighs paper promises. Eventually, confidence breaks. And when it does, silver doesn't drift higher. It reprices violently, compressing years of monetary distortion into a sudden move. This isn't speculation or a bubble. It's the delayed consequence of reckless policy. You can't print money endlessly, punish savers, reward debtors, and expect stability. You can't build prosperity on credit consumption without paying the bill. Silver's rise is really the dollar's fall. Less labor, less energy, less food, less metal. The dollar buys less of everything. That weakness is structural, not temporary. The Fed is trapped. Raise rates enough to defend the currency, and debt markets implode. Governments can't pay, corporations can't refinance, bubbles burst. Keep rates low and inflation accelerates, destroying credibility. There is no painless exit, no soft landing. So the Fed does what it always does, more inflation disguised as stimulus. Silver reacts accordingly. What makes silver especially dangerous to the system is its size. Compared to global capital markets, silver is tiny. It doesn't take trillions to move it. Just a modest shift in confidence can send prices soaring. That's why silver is volatile, ignored when trust is high, feared when trust collapses. It doesn't fit into a debt-driven world. It exposes it. People often focus on manipulation, but manipulation only works when fundamentals allow it. You can press down on a spring for a long time, but eventually the pressure releases, and the move is explosive. Silver's surge isn't about getting rich. It's about honesty. It's about markets finally reflecting the cost of decades of monetary irresponsibility. Savers are realizing paper promises guarantee loss, while real assets preserve purchasing power. When silver breaks higher, the narrative will flip. Critics will suddenly claim it was obvious, blaming speculators or greed, anything but the central banks that caused it. But the truth is simple. Silver didn't rise. The dollar fell. And as long as governments spend what they don't have, as long as central banks print what they didn't earn, and as long as people trust a system built on debt instead of value, silver's message will only get louder. Ignore it if you want, but history is clear. Hard money always has the last word. The Fed hasn't just miscalculated, it has lost control. What we're witnessing now is the inevitable consequence of decades of bad decisions stacked on top of each other. The illusion of control persists only because markets are addicted to cheap money. But addiction isn't stability, It's dependence, and dependence always ends the same way. Central bankers want you to believe they're pilots guiding the economy through turbulence. In reality, they've already lost the controls. They aren't pilots guiding the economy. They're passengers who broke the instruments and are now guessing which way is up. Interest rates have stopped being a tool. They've become a trap. Raise them, and the debt implodes. Keep them low, and inflation accelerates. That's not control, it's paralysis. For decades, the Federal Reserve promised it could fine-tune the economy, claiming inflation could be engineered, bubbles contained, and recessions erased with liquidity. Each crisis was met with the same prescription: slash rates, expand money supply, inflate the balance sheet. It worked in the short term, but every cure became the disease. The economy stopped responding to interest rates long ago. That should terrify anyone paying attention. Near-zero rates and trillions in stimulus now produce less growth, not more. It means the system is drowning in debt. Productivity has been replaced by leverage. The Fed has painted itself into a corner with no escape. Inflation is the proof. For years, officials insisted it was under control. When prices rose, they called it temporary. When it persisted, they redefined the basket, excluding food, excluding energy, telling people not to trust their own eyes. But inflation doesn't care about narratives. It shows up in rent, fuel, and groceries. Once embedded, it isn't managed. It's endured. The Fed's real crisis isn't inflation, it's credibility. Central banking only works as long as people believe in it. The moment the public realizes money can be created endlessly while value cannot, the game ends. Confidence is fragile, and once lost, it doesn't return with a press release. What makes this moment unprecedented is scale. Never before has so much debt existed at such low rates. Governments can't function if borrowing costs normalize. Corporations can't survive without constant refinancing. Asset prices depend on cheap money the way a patient depends on oxygen. Remove it, and the system crashes. Keep it flowing, and the currency dies. That's why every Fed decision looks contradictory. They talk tough about inflation, then panic at the first sign of stress. They promise discipline, then flood liquidity when stocks wobble. Markets don't believe their words anymore. They watch their actions, and those actions scream fear. True control would mean accepting pain now to avoid catastrophe later. But the Fed never chooses pain. It postpones it. Each delay makes the reckoning worse. Recessions are necessary. Bankruptcies are cleansing. Malinvestment must be purged. Instead, the Fed props up failures, ensuring the next collapse will be larger. The irony is that the Fed was created to stabilize markets, yet it has delivered instability on a scale never seen before. Booms and busts are more extreme, bubbles bigger, crashes more violent, and the gap between financial markets and reality grows wider every year. Gold and silver understand this. Hard assets don't respond to speeches, they respond to trust. And trust in central banking is eroding. Precious metals are the lie detectors in a system built on denial. The Fed never had control. It was always an illusion. You can't centrally plan money without distorting markets. You can't manipulate rates without misallocating capital. You can't print prosperity. What comes next won't be gentle. Inflation, currency crisis, market crash, the outcome is the same. Years of intervention can't be avoided. The Fed can delay the reckoning, but it cannot prevent it. And when the public finally realizes the people in charge never had control, the shift from paper promises to real value will be swift, brutal, and irreversible. Paper markets are already cracking. The system hides stress until it can't anymore. For years, investors believed price discovery happened on screens, derivatives, futures, leverage created in infinite supply. But markets only function when paper claims can be converted into real assets. That link is breaking. The financial system runs on promises, paper gold, paper silver, paper oil. These contracts were never meant to be redeemed en masse. They were designed for liquidity, hedging, speculation. Over time, they became tools to suppress prices and manufacture confidence. As long as cash settlement was accepted, the illusion held. But now the gap between paper supply and physical reality is too wide. There are far more claims on silver and gold than metal available. This works only as long as nobody demands delivery. Once trust in currency weakens, paper promises lose appeal. You can't print metal. You can't settle shortages with spreadsheets. When stress hits paper markets, the response is always the same. Rule changes, margin hikes, trading halts, temporary interventions that never go away. These aren't signs of health. They're emergency measures buying time. And buying time doesn't solve the problem. It compounds it. Paper markets were built for stability, not for debt saturation and monetary debasement. Central banks can expand balance sheets without limit. Paper assets multiply endlessly, but physical assets do not. That imbalance eventually asserts itself. Silver is the perfect example. It's consumed, not just stored. It's mined slowly, expensively, and in declining quantities relative to demand. Yet on paper, supply looks infinite. Futures contracts can be created with a keystroke, suppressing price without regard to actual availability. That disconnect can last years, but not forever. Eventually, someone asks for delivery and discovers the system was never designed to meet demand at scale. When paper markets break, they don't break politely. They break through force majeure clauses, cash settlements, and redefined ownership. Suddenly, what investors thought they owned is just a claim on a promise. And in a crisis, promises fail first. That's why physical premiums rise even when paper prices don't. That's why shortages appear despite ample supply on exchanges. That's why the real market and the quoted market tell different stories. One reflects reality, the other reflects desperation. Defenders say derivatives add efficiency, that leverage is normal. And in normal times, they'd be right. But these aren't normal times. Permanent deficits, monetized debt, negative real rates. This is a different world. Paper markets depend on faith. Faith that contracts will be honored. Faith that currencies retain value. Faith that liquidity never disappears. Once that faith erodes, paper becomes a liability. What comes next is repricing. Not because speculators are excited, but because reality demands it. Physical assets will eventually have to rise to a level where supply and demand meet without the crutch of leverage. That price will look outrageous to anyone who trusted manipulated charts, but to those who understood the imbalance all along, it will simply confirm what they already knew. The collapse of paper markets isn't just technical, it's psychological. It begins when investors stop asking about returns and start questioning whether they'll get their capital back at all. At that point, paper promises are abandoned and tangible assets are hoarded. This shift doesn't crawl forward, it accelerates. Each failed delivery sparks more demand for physical ownership. Each attempt to patch the cracks only proves the cracks are real. Paper markets were built on the assumption that trust would last forever. It never does. And when trust finally evaporates, the difference between owning a promise and owning reality becomes painfully obvious. History is repeating, but this time the scale is far greater. Debts are bigger, bubbles are larger, promises are more extreme. And when history repeats under those conditions, the consequences aren't mild corrections, they're systemic breakdowns. Every major collapse follows the same script. Easy money distorts behavior, debt replaces savings, speculation masquerades as investment, warnings are ignored, and those profiting most insist the bubble can never burst. The actors change, but the story doesn't. In the past, excesses were limited by scale. Governments couldn't borrow endlessly. Central banks couldn't expand balance sheets without limit. Today, Those boundaries are gone. Money can be created digitally in staggering amounts. Debt ceilings are raised as formalities. Deficits are routine. That's why this cycle will end differently. When past bubbles burst, there was still room to maneuver. Rates could be cut, balance sheets expanded, confidence restored. Now those tools are exhausted or outright dangerous. Cutting rates fuels inflation. Expanding balance sheets weakens currencies. Stimulus destabilizes instead of stabilizing. Look at the psychology. In every bubble, the public believed the rules had changed. Tech in the late 90s, housing in the mid-2000s. Today, it's central banking itself. The belief is that policymakers can print without consequence, that debt doesn't matter, that markets can be supported indefinitely. That belief is the bubble. The irony is that the more people trust central planners, the more fragile the system becomes. Artificial stability invites risk. Low rates encourage leverage. Bailouts reward failure. Over time, the entire economy is built on intervention. Remove it and everything collapses. Continue it and the currency dies. Asset prices tell the story. Stocks, real estate, and bonds are priced for perfection in a world that is anything but perfect. They assume low inflation, low rates, endless liquidity, conditions that never last. When they reverse, prices don't drift lower. They gap down because there's no foundation beneath them, only cheap money. Meanwhile, hard assets behave as they always have. Ignored during confidence, then suddenly rediscovered as stores of value when paper wealth proves illusory. What makes this moment dangerous is that there's no reset button left. In the past, crashes forced societies back to savings, production, discipline. Today, every problem is met with more consumption, more debt, more intervention. The lesson of history isn't being learned, it's being denied. And denial doesn't prevent consequences. It guarantees them. This time is different has never been true. What is true is that this time is bigger, distortions are larger, imbalances more extreme, and faith in central control more misplaced than ever. When confidence breaks, it won't be contained to one market or one nation. It will be global, because the experiment has been global. People will be shocked, not because the outcome was unforeseeable, but because they chose not to see it. History didn't hide its lessons, they were ignored, and now the bill is coming due. Repeating history doesn't mean reliving the past exactly. It means making the same mistakes under new conditions. And when those conditions involve unprecedented debt, leverage, and monetary expansion, the resolution won't be a small correction. It will be a reckoning. When silver hits $300, the question won't be, how did this happen? It will be, why didn't we listen sooner? And by then, the shock won't be silver's price. It will be the cost of trusting a system that insisted it could never fail.